There's a little microphone on the table in front of you. You just have to press on the button until the light turns green if you want to use the microphone. This is webcast, so we need to record it. And with that, I'll turn it over to Governor Poloz for his opening statement.
Well, thank you, Louise. Good morning, everyone. Thank you for being here today. Senior Deputy Governor Wilkins and I are pleased to be with you to talk about the latest issue of our Financial System Review, which we published this morning. Permettez-moi d'abord de rappeler l'objectif de la revue. L'objectif est de mettre en lumière les principales vulnérabilités du système financier qui peuvent interagir avec les chocs économiques et amplifier leurs effets. Nous surveillons l'évolution de ces vulnérabilités. Nous analysons des scénarios de risque extrêmes et nous évaluons les conséquences potentielles de ces risques sur le système financier et l'économie si un tel choc se produisait. Les grandes vulnérabilités que nous observons aujourd'hui sont les mêmes que dans la revue de 2018. Le niveau élevé d'endettement des ménages et les déséquilibres sur le marché du logement. Cependant, elles ont légèrement diminué depuis un an. With respect to household indebtedness, the mortgage stress tests introduced last year have improved the quality of new mortgage lending. As a result, the share of new mortgages going to highly indebted households, those that owe more than 450% of their income, has declined significantly. Also, the number of Canadians falling behind on their debt payments remains low. The combination of the revised mortgage guidelines and past increases in interest rates have helped to slow the pace of household borrowing and stabilize the overall household debt-to-income ratio in Canada. These are encouraging signs, but there are important reasons for continued vigilance. First, because the total amount of debt carried by Canadian households is so large, we know that it will be with us for a long time. Second, a large share of this debt is with highly indebted households. And third, the decline in global bond yields since the beginning of the year has lowered Canadian mortgage rates, so household borrowing is likely to pick up again. The bank is also closely monitoring the risk that stricter mortgage guidelines are shifting consumers away from federally regulated institutions and toward private lenders and credit unions, some of which are not following the federal guidelines. Let me now turn to imbalances in the housing market, which have diminished overall since our last report. We continue to follow three different housing stories here in Canada. The previously frothy markets in Toronto and Vancouver, the markets that are still adjusting to lower oil prices in Alberta and Saskatchewan, and the markets that are functioning normally almost everywhere else. After slowing sharply beginning in 2017, the Toronto area market appears to be stabilizing, while resales and prices continue to fall in the Vancouver area. Prices in both of these areas remain 40 to 60% higher than they were 4 years ago, suggesting that housing imbalances remain an important macro-financial vulnerability. The housing market as a whole continues to benefit from solid fundamentals, including population growth and strong job creation. One more main vulnerability from the last FSR that we continue to watch is the possibility of a major cyber attack on financial institutions or on market infrastructure, such as the payment systems that we all rely on every day. Cyber threats remain a key structural vulnerability, and the number of incidents that have or could have resulted in substantial financial losses has increased steadily over the past decade. Financial system participants are particularly concerned about cyber incidents at third-party service providers. The bank has been working with major banks and financial market infrastructures to improve coordination and information sharing, which is crucial for improving resilience. In this FSR, we have placed more focus on two other vulnerabilities. One relates to corporate debt funding. The level of non-financial corporate debt in Canada is well above its historical average. While the average firm has enough liquid assets to manage an increase in interest rates or a decline in income, some companies have relatively few liquid assets and less capacity to service their debts. In this context, lower-rated firms are relying more on U.S. high-yield bonds and leveraged loans and borrowers in these markets are more vulnerable to sudden swings in investor sentiment. We will be monitoring the situation. We're also putting more emphasis on the vulnerability related to crypto assets. These continue to pose little threat to the financial system, but crypto markets and the uses of the underlying technology are changing quickly, so implications for financial stability might arise suddenly. I would add that recent swings in prices for crypto assets and losses at crypto companies underline the need for investors to understand all the risks before they enter these markets. Nous avons aussi ajouté une nouvelle vulnérabilité, les changements climatiques. Diverses autorités ont pour mandat d'analyser et atténuer les effets des changements climatiques. Pour leur part, les banques centrales se concentrent sur les risques des changements climatiques pour l'économie et le système financier. Il y a les risques physiques liés aux phénomènes météo extrêmes et il y a les risques liés à la transition vers une économie mondiale à faible émission de carbone. La Banque intègre désormais ces risques dans son analyse de l'économie et du système financier du pays. Nous cherchons aussi à mieux comprendre les risques climatiques qui touchent notre mandat. Turning from vulnerabilities to risks, I'll conclude by saying that the overall risk to the Canadian financial system has increased slightly since our last assessment nearly a year ago, but this is due to the recent slowdown in economic growth in Canada and abroad. However, as we said on our recent monetary policy report, we do expect economic growth to pick up later this year. As for the risk of a severe house price correction, we judge that to be moderate and declining, with froth having decreased in the Toronto and Vancouver areas. Meanwhile, the risk of a sharp increase in long-term interest rates, driven by higher global risk premiums, is moderate but is increasing. And with that, Senior Deputy Governor Wilkins and I would be happy to take your questions.
Thank you very much. So first question in the room goes to Greg.
Good morning. Greg Quinn, Market News International. I wondered if you could speak a bit to the escalation in the China-U.S. trade war, and specifically, the connections between Canada and the U.S. are well understood. What might happen to Canada's financial system if China gets into distress because of its trade dispute with the U.S.?
So certainly, as highlighted in our NPR, the escalation of the trade war was our primary or our first top risk to the outlook. So that remains the case today. And of course, the situation evolves day by day. In terms of the connection to financial stability risk, yes, the Chinese financial system has long been identified as a place where there were vulnerabilities that with some sort of shock could produce reactions that had spillover effects on financial markets globally. However, there is still considerable, let's say, offsetting capability in China to manage various shocks. So we have no update on that for you today beyond that, unless Ms. Wilkins would like to add something.
I think you covered China. You covered China. I would just say that the context in which the trade war between the U.S. and China is occurring is one in which the global economy is overall more indebted than it was even at the time of the crisis. I mean, global debt as a percent of GDP, global GDP is over 3.5 times. And so what that means is that if it escalates to a point where it threatens the expansion, then a downturn would occur in a context where either governments or households or corporations or all of the above are highly indebted. And we know what happens in that case. It's an application mechanism, and it means that stresses can occur in different parts of the systems. And that's why we do this report and we do the stress tests that we do.
Secondly, you mentioned the slight moderation in vulnerabilities in the housing markets and indebted consumers. how much of that is attributed to a more accommodative stance that the Bank of Canada has taken this year, along with what we've seen globally with monetary policy becoming a bit less restrictive?
I would say pretty well none of it. Most of what we're documenting there is, a dampening of extrapolative expectations. So expectations of price increases in both Toronto and Vancouver have calmed down considerably. So that's really important. What that means then is that the markets are returning to what we would call fundamental levels, which are driven by strong underpinnings from population and job creation in both areas. And so that return to fundamentals is always a positive from the point of view of financial stability. The other side of the coin, though, is that we're dealing with the slowdown in the economy, which, as I said, overall has contributed to a modest, or actually a slight, increase in what we would measure as overall financial stability risk. But we would judge that to be temporary, that as we go through to the second half of the year, we see increasing evidence that growth is returning to a trend line. And so, I'm quite comfortable that a few months down the road, we'll have in our minds that those financial stability risks have receded back to at least to where they were.
Next question is from David over on the left.
Yeah, good morning, Governor. David Younger of Reuters. I'm interested in your focus on the fragility of corporate debt funding. Was there any one particular factor or factors that suddenly emerged that made you decide to talk about this now?
No, well, it's figured in our FSRs for, I guess, at least a couple of years. Certainly it was in the one a year ago, but it was in the part about other vulnerabilities. We've been monitoring it over time, and as we gather more insights into it, and it's actually kind of a global thing, not just us. So it's receiving more attention, not just by us, but others. So we chose to give it, more full treatment in the report. But for the actual, analysis of it, would you like to say something?
Well, sure. I keep forgetting about the
Yes.
the technology. What's interesting about this current rise in the levels of corporate debt is not only the levels and the institutions that are involved, but also just the source and the type of corporate debt. And so what's caught our eye, and we've got more analysis of it for Canada, but also globally, is just that a lot of the debt, more of it is high yield, so lower quality. For some Canadian companies, particularly in the commodity sector, quite naturally they're tapping U.S. markets in U.S. dollars, not only because that's where those markets are, but also because their products are priced in U.S. dollars. As well, some of this debt is, more and more of this debt is being issued by non-bank financial institutions. So what we used to call shadow banking, which is a good thing. It increases the range of debt options or financing options for corporations, and that could be stabilizing. But at the same time, some of the types of debt, leveraged loans, for example, being packaged into CLOs, which we talk about, do create some concerns about how that market might behave, both from the investor side, but the borrower side, in times of stress.
And secondly, is there a way of is there a kind of a probability in your mind, or where you can rank how important this risk is? Whether it's you say you're watching it closely, does that mean that it may well not happen, or are you sure that down the line this may come back to bite?
Everything in the financial system review is a vulnerability or risk. It's not our base case at all, so it's something that could happen. It's difficult to rank the risks in the sense that whether or not they crystallize depends on the trigger. And again, those are things, if we knew them, then they wouldn't be risks. We'd have them in our base case. And so I would say when you look at Canada for the corporate bond issue that we've raised, you can see that most of the non-bank financial corporate debt that's higher yield and is in U.S. dollars, is coming from a particular sector. So there's a share of corporations that are in maybe a little bit more worrisome, have more debt at risk than others. Globally, again, it depends on the area. One area that I would look particularly carefully at are emerging markets who have a very rapid growth and a high percentage of corporate debt in U.S. dollars, and in that case, some of their revenues actually might not be matched in U.S. dollars.
Theo?
Hi, good morning. I'm wondering if you could explain how this analysis of financial stability risks plays into monetary policy decisions, if at all. For example, when you talk about the overall risk rising, does that have any implications? Does it make it more difficult or easier to raise rates or lower them?
Well, it enters into the discussion. For a while there, we were in a phase where both macro stability and financial stability considerations would lead you to the same conclusion. But then we get into phases such as we're in now where they represent a bit of a trade-off. There's no question about what our primary objective is. That doesn't change in this, which is, of course, keeping inflation on target, and that's projected inflation on target. But we do have, as you know, we have a range around that inflation target for many reasons, one of which is it's hard to keep it inside that range just because of how monetary policy works. But secondly, you do have the ability to take a little more time to get back to target or a little less time depending on the circumstances. And one of those considerations would be financial stability risk. So those things play into that discussion, but they never dominate it. They're kind of like the side effects that come along with with the surgeon is explaining what they're going to do to make you well. They remind you, but also there's some side effects, and we'll offer some mitigants for those side effects. But primarily, it's the macroprudential framework, which is keeping the financial stability risks in a zone of acceptability, if you like, and that's that extra tool in the system gives us that ability to kind of treat them as secondary and not as our primary.
So is it fair to say that the easing of global financial conditions we've seen since the end of last year, one of the costs of that may be growing financial vulnerabilities that possibly central banks won't be able to deal with if they need to focus on their primary objectives, as you mentioned?
Yes, that is fair. In fact, there's a line right in our FSR that says that, and there's a line in the global FSR from the IMF that says exactly that. Because financial conditions have actually become more accommodative, that in principle, you can forecast that would contribute to the further buildup of financial stability risk or vulnerabilities through time, more than what would have been the case if bond yields had remained where they were, but they've fallen by some 60 basis points. So that's one of the things, as I mentioned in the opening statement, that yes, we're quite encouraged by how the consumer debt has evolved. That's quite helpful. Of course, we're forecasting a return to a stronger economic growth. We're forecasting a return to growth in the housing market. The latest data suggests that we're probably right about that. And then, of course, we have lower interest rates now than we had 6 months ago. So there's a lot of ingredients there that would suggest, yes, I expect credit growth to pick up. As long as it remains, somewhat in line with nominal income growth, then our sustainability measures and our risk measures will stay where they are. But it's something we watch and make sure that it doesn't take off again and start adding to those vulnerabilities like it was before.
Courtney.
I was interested in the corporate debt thing, and the question was asked and pretty much answered. But I wonder if you could move from the generality that you have here to some precision or proportion of how serious it is in Canada. Do companies with less capacity to service their debts comprise some proportion of the community?
Okay. Ms. Wilkins?
Well, if I direct you to the financial system review because there's a really great summary, I think, of the question that you're asking. So it's one thing for a corporation to be indebted, but it's another if they're indebted, if their capacity to make interest payments is lower, and if the liquid assets they have at their disposal to, in case they need them to pay their debt obligations, is also lower. And that, using those two metrics, you can calculate debt at risk. And we've done that for debt in the non-financial corporate sector that's commodity related and that isn't. And you can see that the big increase in the debt at risk is really coming from the commodity sector. So it would be that share of corporations in Canada. And you have to remember that that's debt at risk. It doesn't mean that that's going to materialize. It's just a metric of where the vulnerability is building. What it leaves corporations in general kind of open to is changes in investor sentiment where they can't roll over their debt, and if they do, it would be at a really higher price. Or they have a shock to their income. So their profits, they become less profitable than they were in the past, and then it makes it even more difficult to do the repayment. So what that means is that overall for Canada, when we looked, it didn't look to be a generalized issue, and even in the commodity sector, it's hard to gauge that it's, there's red lights or anything. But I think more generally, what we're concerned about is if there were some kind of shock that led to an increase in interest rates, an increase in the yield curve, how would that play through for those companies and also for investors? So I would also direct you to our stress test on mutual funds that have corporate bonds in them and what that would mean there. All in all, it looks like it would be costly, but from a financial stability point of view, given the scenario that we did, it is something that we've seen in the past and overall didn't look like a financial stability issue for the general system.
Do you get down to which commodities and therefore perhaps which regions?
Yeah, this is mostly lower oil prices. It's in the energy sector, which is the main sector that's drawing that line up. That's completely understandable given what we've been through, and part of the adjustment process to those lower oil prices will be to see that thing level out and as firms restructure their balance sheets, and that's a steady process that's underway. So, and actually, oil prices are higher today than they were just a few months ago. So there's also a stabilizer coming into that system as we speak. So remember, probably the most important thing on that kind of formulation is the revenues that the firms are getting. And so if revenues are picking up because oil prices are firmer and they're getting more deliveries, through trains and so on, then overall that thing will ease back as the economy moves forward. And that's what I would expect to see given our base case scenario. Plus the firms adjust to the new circumstances. One of the things we mentioned in the analysis is there's more of that priced, it's borrowed in US dollars. that's actually, in this kind of situation, it's a hedging strategy because your revenues are in US dollars. And so it's better to have that kind of matching. So it's actually something that makes it more safe than not less so.
I've got Kevin and then Carl.
Good morning, Kevin Carmichael from the Financial Post. The FSR seems to talk about the decline in credit growth as a positive thing. I guess it is, given what we've been reading from this report for the last few years. Is there a point where credit growth is too slow? Is there a point where something less than the 3% rate we're looking at now would actually become a risk to either the economy or financial stability?
It would need to be judged in the context of other things, but certainly it's true if the economy were going into a more generalized slowdown, one of the indicators of that would be a slowdown in credit growth. But we would already have seen it probably as indicators of housing slowing. So actually that happens before because housing starts and sales, they happen, and then the credit data comes a little bit slower, catches up to it. And before that, we've got building permits and stuff. So we kind of have indicators that are ahead of credit. There's never, even back in the 1980s, we thought it might be a leading indicator or a target, and we tried hard and it never worked that way. So it's more of a lagging indicator. But so you're on to something there for sure. If the slowdown we've seen, some of that slowdown in credit is no doubt just associated with that slowdown that we've seen in the economy, and so I'm expecting it to pick up a little as we get into the second half of the year, but also you'd expect nominal income to be rising, to picking up speed at the same time. And as I said a moment ago, that still keeps me hopeful that actually the ratio of debt to income won't begin to rise again. It'll stay flat and possibly declining. It'll be it's going to be years while we watch that thing decline. That's for sure. If we disentangle how we got here, the biggest part of it is just because of higher prices of houses. So, everybody that wants to become a homeowner, if they face that steep climb because of affordability, whether it's, the Toronto or Vancouver areas in particular, well, that's how they get a big mortgage. And we know that something like, 11% of households have higher than 450%. And that 11% of households holds 40% of the outstanding debt. So it's very concentrated in those two places where it costs so much to buy a home. So we can explain all that, and we see housing prices have calmed down. So we're reasonably hopeful that won't resume.
My follow-up has nothing to do with that question. The FSR talks of how the central bank is participating in the review of the open banking regime. I wonder if it was possible for one or both of you to handicap how an open banking regime might help or hurt financial stability. Governor, your most recent speech sort of talked about how probably a lack of competition in the financial sector has left us with this, so little choice in mortgages, that the fact that we have this 5-year reset has become something of a vulnerability. Yet on the other hand, we see lots of commentary from the financial markets talking about how third parties represent a particular threat around the cyber attack concern that you raised in the report. So how should we be thinking about open banking as it relates to financial stability?
Well, I'll just sketch a bit of a framework, then I'll turn it over to Carolyn. I think first of all, open banking is not a lights on or versus lights off concept, although it's often characterized that way. It's either night or it's day. It's more a question of, well, as the financial system evolves, how do we how do we take advantage of new entrants, new innovations in the marketplace? Well, they need some data to do that. So there needs to be some form of mechanism that allows that to occur. And so what are the risks versus the benefits of various frameworks around that? And there's considerable activity on that among central banks, regulators, and of course governments. And it's a big topic at the World Economic Forum. There's lots of activity in this space. So none of us is alone on this. But in terms of, well, maybe just like to take over and talk about any of the risks you'd like to highlight, or what do you think? It's early days. I mean, that's the gist of my answer, and we're watching it unfold and we're participating in it. But that's.
I wouldn't see open banking as a threat to financial stability necessarily at all. When you just think about where the financial system is going, it's opening up. IPs are opening up, data are becoming more available, whether they're shared or they're scraped. And so this is just the way we're going. And so, open banking is about, for the most part, control of data and sharing of data and access. And so, opening that up provides not only more contestability, competition, better services, and hopefully lower costs for consumers, but it also creates more diversification of players in the system, and those that are actually still attached to the core system, as opposed to what we see now are new firms kind of going around the system and actually are outside the regulatory framework. How it plays out net in terms of financial stability really depends on the entire framework. So not just the open banking part, but also the regulatory part and the supervisory part, so that new players have, for like activities, if they look like a bank and they're acting like a bank, well, then they get regulated like one. If they're a payment system provider and they're attached to our payment system, then they get regulated too. This more open system brings a lot of advantages that I mentioned, but at the same time, we can't forget about the risks there. And I would highlight the operational risks that focus around cyber. Governor already talked about that, but other ones, because data privacy, continuity of operations, not infecting the rest of the system will just become more and more important as the system becomes more open. So net, it could be a very good thing for competition, contestability, and financial stability. It does depend on the full package.
So we've got time for 2 more questions. So we'll go to Carl and then finish with Kim.
Thanks, Carl Meyer, National Observer. So given your acknowledgement of climate risks in terms of loans from banks to carbon-intensive sectors, I'm wondering if you think the Office of the Superintendent of Financial Institutions should mandate that the institutions it oversees quantify their climate risk as opposed to the recommendation, the expectation they have now? Would that contribute to better transparency?
Well, that is a question for OSFI, not for us. It's not for us to discuss in public, what another sister agency should be doing on their mandate. For us, climate change is, it's of interest to central banks because of central bank mandates and how climate change can affect economic performance on the one hand, and how it can affect financial stability on the other hand. And so that's the narrow focus that we have on it. And, regulations and stuff, that's somebody else's province.
All right, thanks. And my second question is, you talked about how not many firms have disclosed financial impacts of climate change. I've heard the argument that some laws in Canada make it difficult for companies to actually make that disclosure because it would be seen as speculative. I wonder if that's something you've discussed.
It's an interesting question.
That is an interesting question. As part of the global network that we joined on climate change, disclosure, transparency is a big part of that. And what we're observing is that the TCFD, which are the disclosure requirements that the task force came up with in conjunction with the FSB, is a really good start. And I think the companies that are looking at it, for example, pension funds in Canada, some of them have made some steps there and are planning to make steps there. Their observation is that the state of the measurement and the consistency of how actually to do it is evolving, and so their steps are going to be meant to be steps ahead, if they put it that way, baby steps ahead, with a view to full implementation in a few years from now. And I think we at the Bank of Canada adheres to the principle of the disclosure and the TCFDs. There is a question of measurement and consistency of measurement that one can imagine if it's in an actual financial statement or an annual report. You have to think carefully about how that's presented relative to other information that is more black and white. That being said, I don't want to give the impression that we shouldn't work towards it. It's a very important initiative, and it is because when risks are priced properly, then their effects when they materialize are usually less. We saw that during the crisis. The opaqueness of markets was difficult. And so the more we can increase the information that market participants have access to, the better.
Kim?
Thanks. Kim McCrail from the Wall Street Journal. Wanted to turn to household debt and housing market imbalances. And the FSR says that those have eased modestly from a year ago. Has that happened in the way you would have expected, and what has been different from your expectations?
Yeah, I mean, it's many things moving at the same time. So it was never the case that only one way of getting there would work. It's fair to say that we weren't expecting the slowdown, to be as deep or as sharp, I guess is a better term, starting in the fourth quarter. So that's kind of an underlying factor that changes how some of that looks. But in general, what we expected, given what we were seeing, is that this sort of speculative juices in the two housing markets would ease or even go away. And so we talk about the froth, and I've given you the metaphor of the beer. And to remind you, if you pour a beer not in a glass but in a cup, and the foam is on top, the froth is there, and you can't tell how deep you have to go to get to the beer. And it looks like, more froth in Vancouver than we had in Toronto, perhaps. But that's, it remains to be seen how the froth works out. And the policy changes have interacted with the froth, because we can see that the markets that are doing the adjusting are the ones that were frothy, and the other markets seem to be behaving almost exactly how you'd expect them to, given our models. And so, on balance, I'd say, yeah, it's happened more or less as we would hope. Is there anything I've missed that you'd like to add?
I don't think so, no.
Okay. Then, your follow-up.
Does it look like the froth has been completed or is out? And
I'll never make a statement like that. I mean, look, as I said before, both of those markets have really solid fundamentals, and both appear to have, supply challenges. So there's more people that want a place to live than is readily available to them. So you've got right there all the ingredients you need to recreate froth. So there's no doubt that the taxes on foreign buyers has had some effect on that. So there were buyers coming in that were adding to the bidding wars, and some of those there's obviously less of that going on now, and so that combination of things that happened cooled that off. but our economy remains solid. Employment growth has remained very solid. So there's going to be continuing demand for more housing. And it's in this sense that the efforts on the supply side, really are important. And so, even though the new home buyer program is intended to help people cross the affordability barrier, it's also tilted to encourage more building, because you can participate in a bigger way if it's a new house. So that encourages more building, and of course through CMHC there's that $10 billion worth of support for building basically rental accommodations. That's an important initiative, and there are initiatives like that at the provincial level, all of which are going to be adding to that supply side, which is a positive too. So I wouldn't, again, go back to your original question, I'm not going to say categorically that it's all behind us, but it's encouraging what has occurred in that respect over the past year.
And that concludes today's press conference. Thank you, Governor. Thank you, Senior Deputy Governor, and thank you all for coming.